First off, I would like to congratulate you for watching this video. The mere fact that you are even thinking about Roth IRAs or IRAs in general means that you're already doing better than most people, given that only 29% of US taxpayers have either kind of IRA. Moment of silence for the 70% of people that aren't taking advantage of tax advantage investing. Breaks my heart. Additionally, the fact that you read the title of this video means that you understand that you actually have to pick investments within your IRA account, and that the IRA itself is not an investment, just an investment account. Many people will contribute to an IRA for years, not realizing that the money is just sitting in cash and not getting automatically invested. Shockingly common mistake. Moment of silence for those people as well. In this video, we'll briefly differentiate between Roth IRAs and traditional IRAs. We'll illustrate the power of tax-free growth that comes with Roth IRAs so that we can motivate ourselves, and of course, we'll run through a list of ETFs. For each ETF, we'll do an overview with discussions on cost and portfolio composition. All the ETFs in today's list have low fees because Roth IRAs are typically intended for long-term investing, and the compounding opportunity cost of money lost due to fees will absolutely rob you over time if you're not careful. We'll also have a more graduate level discussion on optimizing asset allocation for tax efficiency within the three types of investment accounts: tax deferred, tax free, and taxable. If at any point you decide you like this video and find it helpful, don't forget to hit the like button because that's what it's there for. Also, if you want some free stuff, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Without further ado, let's get started. IRA stands for Individual Retirement Account. Traditional IRAs and Roth IRAs differ in the timing of their tax advantages and how they restrict and dictate access to funds. Traditional IRA contributions are tax deductible for the year that you make the contribution. Withdrawals are taxed at your income tax rate when you make them, presumably in retirement. With Roth IRAs, you pay the income taxes up front, but you don't have to pay them when you make the withdrawals in retirement. So it's tax me now or tax me later. But in either case, when you buy and sell in these accounts, you are not triggering capital gains taxes like you would in a taxable brokerage account. A health savings account, or HSA, is triple tax advantaged, meaning that HSA contributions are tax deductible, investment growth in the account is tax-free, and qualified withdrawals are tax-free. But that's a video for another day. The tax deduction of a traditional IRA is an obvious benefit, but people underestimate the power of tax-free growth in a Roth account. Look at this graph. The blue represents Roth contributions, the red represents account value with growth. With a Roth, you've already paid taxes on the blue, and the red is completely tax-free. Notice how the red is significantly more than the blue. At retirement, it is all yours, and you don't have to give Uncle Sam any of it. Like I said, it's powerful. But which is better depends on if you believe you will be in a higher or lower tax bracket in retirement. A Roth can be a no-brainer for young investors that are just starting off and are in a low tax bracket. As they get older and increase their income, it can make more sense to switch to traditional and take the tax break up front. The general wisdom is this: if your combined federal, state, and local marginal income tax rate exceeds 32% when you're under 40 years old, or over 24% when you're over 40, you're better off going with traditional. Anything outside of that, Roth can be the way to go. In any case, there is value in having tax-free, tax-deferred, and taxable accounts in retirement so that you can strategically optimize withdrawals for tax efficiency. In general, the assets with the highest growth potential belong in tax-free accounts such as Roth IRAs, this being your equities and growth stocks, etc. You want to take advantage of that tax-free growth as much as possible. Tax-inefficient investments are best kept in tax-deferred accounts, such as traditional IRAs. So in general, the income-producing assets, such as REITs and bonds, maybe you could throw dividend stocks in this category as well. Dividend and bond interests are essentially forced distributions that trigger taxable events. Additionally, anything with high turnover will be tax inefficient. Turnover ratio is the percentage of a mutual fund or ETF that is bought and sold within a year. For instance, actively managed mutual funds and ETFs, they tend to do a lot of buying and selling, which trigger capital gains taxes, specifically short-term capital gains taxes, which is the higher capital gains rate that you pay if you sell for a profit after holding for less than a year. In a tax-deferred account, an investor doesn't have to pay taxes on any of the capital gains, interest, or dividends. They just pay income tax when they take the money out in retirement. As far as taxable accounts, it goes without saying that investors are best served by keeping the most tax-efficient investments in there. This is going to be the growth stocks and ETFs with low turnover and low dividend yields. Growth stocks typically don't pay dividends. Instead, they reinvest back into the growth of the company. So if an investor is holding a growth stock that isn't paying a dividend, they can essentially defer taxes all the way until they decide to sell. And again, if they hold for more than a year, they receive the lower long-term capital gains tax rate. If you want to get into more graduate level stuff, You can make the argument that high beta assets, meaning anything risky or volatile, take for example small caps, can be a good fit for taxable accounts because they provide opportunities for tax loss harvesting, this being the intentional selling of assets at a loss to offset capital gains tax due on other investments. But we can save that for another day because I think everyone just wants to get to the ETFs. So we said that we want investments with the highest growth potential to go in our Roth IRAs. So that means we want to take a look at equities. The simplest and easiest way to get broad exposure to equities is to just own a broad market index fund or ETF. The idea here being that instead of trying to pick individual stocks or sectors to outperform the market, because statistically you will probably fail in doing this, you just want to own the broad market. Don't try to find the needle in the haystack, but just buy the whole haystack. VOO is a low-cost ETF by Vanguard that tracks the S&P 500, this being the 500 largest U.S. companies. So it's exactly what you expect. Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Facebook, etc. Even though it is only the top 500, it's generally referred to as the market because these companies are so large that they essentially make up the entire market. With over $250 billion in assets under management, this is one of the most popular ETFs in the world. The expense ratio is only 3 basis points, this being the annual percentage that we have to pay for management. This would mean that on a $10,000 investment, you only pay $3 a year. So this is dirt cheap. But I'm always stressing this on this channel. Small differences in cost may seem small, but they can compound into large differences over time. This calculator shows the difference between two investments of $6,000 a year, this currently being the annual contribution limit for Roth IRAs. One ETF charges 3 basis points, and the other charges 100 basis points. Assuming equal returns of 10%, the 100 basis point ETF will cost over $500,000 more over 40 years. Again, this assumes equal returns. But beating the market consistently over a long-term time horizon is very tough. So focusing on things that you can control, such as cost, can certainly be the move. However, VOO is mostly large cap stocks. Large caps are often seen as stable, transparent, resource-rich, long-standing companies that can better withstand rough times in the economy. Small caps, on the other hand, are often seen as riskier, but they can provide attractive upside potential that can make it worth the added risk. In either case, there is certainly diversification value in owning both. Those that want to own the broad market in addition to some mid and small cap stocks can check out VTI. VTI tracks the total U.S. stock market with exposure to over 4,000 U.S. stocks, all for the same price of 3 basis points. But don't think that because VTI has 3,500 stocks more than VOO, that these two ETFs will perform significantly differently. These two ETFs overlap 84% by weight and thus perform very similarly. Because of the additional mid and small cap stocks, VTI tends to be slightly more volatile. But mid and small cap stocks tend to outperform large caps over time, so VTI tends to slightly outperform VOO over the long run. But we're really only talking about a few basis points here over a span of decades, so not a huge difference. But I did a more detailed video comparing and contrasting these ETFs I can link to in the description for those that are interested. However, while both of these ETFs are broad market ETFs that are diversified across all sectors of the economy, they do not have global exposure. They're all U.S. stocks. Those that value the added diversification of owning international equities can check out VT, which is the Vanguard Total World Stock Market ETF. This ETF holds almost 10,000 different stocks around the globe. This is about as diversified as you can possibly get across equities. If owning 10,000 stocks doesn't make you feel diversified, then I don't know what to tell you. Granted, 60% of this ETF is still US-based companies. Let's face it, the US makes up such a big chunk of global GDP. Asian and European companies each make up about 15% of the weight in VT. US stocks have historically outperformed international stocks, but this is no guarantee in the future. VT charges 7 basis points, which is still extremely cheap, but if you find yourself cringing about that extra 4 basis points, you can always mix VTI with VXUS to achieve the same portfolio. VXUS is the Vanguard International ETF, which also charges 7 basis points, but by mixing VTI and VXUS, you'd only pay 3 basis points on the US portion of the stocks via VTI, instead of paying the full 7 basis points in VT. So this trick works for cheapskates, but it also works for control freaks that want to have more control by customizing their asset allocation. Those that prefer growth stocks over value stocks or broad market indices can check out VUG. This is the Vanguard Growth ETF. A growth stock is a share of a company that is expected to grow significantly faster than the broad market. These ETFs typically do not pay dividends. Instead, they tend to reinvest earnings to accelerate the growth of the company. Growth stocks often trade with high price-to-earnings ratios as future growth is priced in. If all goes well, shareholders can see dramatic price appreciation, but if growth expectations are not met, these stocks can see dramatic declines. But probably not as dramatic as me holding Terra Luna. I don't even want to talk about it. VUG only charges 4 basis points and has much exposure to the technology sector. Looking at industry exposure, we see software companies, technology, hardware, semiconductors, etc. This ETF is diversified across 270 growth names, but with 50% of weight in the top 10 names. The top 10 names are very much what we would expect: Apple, Microsoft, Amazon, Tesla, Nvidia, Meta, etc. Along similar lines, we have QQQM by Invesco, which is basically the same thing as the famous QQQ ETF, but with a 5 basis point cheaper expense ratio. I did a more detailed video on these that I can link to in the description. QQQM tracks the top 100 largest non-financial companies listed on the NASDAQ exchange. It has very similar tech and growth vibes as VUG, but it has a higher concentration of large cap stocks than VUG. QQQM and VUG overlap more than 60% by weight. QQQM has a 15 basis point expense ratio, so you can see why some people would rather just own VUG for 4 basis points given the overlap, but it's not like 15 basis points is extremely expensive either. Also, QQQ has outperformed VUG recently, but obviously this is no guarantee in the future. Those that like the growth vibes of VUG but want even more tech exposure can check out FTEC. This is the Fidelity Information Technology ETF. With an 8.5 basis point expense ratio, this ETF provides low-cost exposure to the tech sector. Keep in mind that many of the names that we think of as big tech technically do not classify as tech stocks. Of the names we mentioned from VUG and QQQM, Amazon and Tesla are technically consumer discretionary. Google and Meta are technically communication services. These companies are therefore not included in FTEC. While FTEC provides exposure to over 300 tech names, nearly 45% of this ETF is Apple and Microsoft. So some would say, why pay an ETF expense ratio when you can just own Apple and Microsoft directly? Granted, the expense ratio is very low, but in any case, if you buy this ETF, you better be a fan of those two tech giants. So what are my thoughts? Needless to say, I am a big fan of Roth IRAs and I have one myself. It's a no-brainer for young people who are just starting off and in a low tax bracket. At some point, it can make sense to switch over to traditional, and there is certainly value in having both the tax-free and tax-deferred tax buckets to strategically take from in retirement. But at only $6,000 a year, it's a no-brainer to max out either IRA. Even for people who are looking to save their capital to get into something like real estate investing or to start their own business for an expected higher return, it can make sense to max out that IRA first just to make sure that you have that safety net in retirement. And IRAs give you more options and control than 401ks. Sometimes this is a bad thing because it allows you to ape all of your money to something stupid that goes to zero. But on the bright side, it gives you the option to pick low-cost ETFs and mutual funds. Sometimes you just get a bad 401k provider with stupidly high fees. The 401k is a great investment account, but not all 401ks are created equal. But again, video for another day. As far as the ETFs, I like them all and I own most of them. But the bulk of my portfolio is in the broad market, and from there I have smaller exposure to growth and tech ETFs, and even lesser percentage to individual stocks and cryptocurrency. But if you found any of this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 of Bitcoin with Celsius, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and we'll see you in the next video.